Hey Axia members, this is Brannigan. Welcome. This is the stream for Wednesday, the 30th of October, the penultimate trading day of the month. So hopefully you are well prepared for month end tomorrow. This is a stream all about the footprint tool and market profile. Now, today's going to be a good stream. This is obviously our usual objective approach we take. It's what we want to try and achieve during the stream. And I haven't received any questions and answers. I think you guys are very quiet and a little bit cautious with your questions. That's fine. Do feel free to send in those questions if you have got a question. And what we're going to talk about today is actually something quite interesting. With a focus obviously on the footprint, we're going to talk a little bit about the initiative drive, what it looks like. I'm going to show you in two different examples in essence. Do note this is a standalone footprint strategy. It is very much a momentum strategy and does require relatively aggressive execution. Now, what we're going to talk about is this concept of structure and timing. Now, what I've found throughout my not just my career necessarily as a trader, but also obviously I've been mentoring now since 2014, 2013, and I found that a lot of sort of traders like myself, let's call ourselves retail traders, retail professional traders. In the beginning of our careers, we have a very good understanding of this, or at least we have a few ideas of potential structures. Now, when I say structure, think penants, think inside days, think I don't know, engulfing candles. Okay, these are types of structures. They're types of market events that occur that form a bit of structure, and they give us an understanding as to the potential for price to move in one direction or the other. Okay, now, almost think of it as in terms of these structures give us an idea, a biased idea in terms of which way price may move, or at least a lean in one direction or the other. Okay, now this is the first thing we learn as traders in our career. We learn different types of structures, and that's where a lot of traders stop. If you follow a lot of people on Twitter, you'll always see them posting pictures of these structures, posting pictures of euro is a buy or oil is a sell, etc., etc. The problem with this is that it's not good enough to just understand structure. Okay, now structure can come in different forms. It could be fundamental structure, it could be technical structure. There's various different types of structures that can form in multiple different markets. Okay, but like I said, it's not just enough to be able to identify structure. Okay, because what happens very often is we get a lot of false signals in these structures. Okay, and our only real defense is to be able to learn the ability to time these structures. Okay, now I'm going to show you what I mean in a minute, but in essence, the really good traders, the professional traders that are doing excessively well, and that I've fortunately have known for a number of years, they mix they find a combination between timing and structure. In other words, what they do is they don't just simply, for example, go long when there's structure and they think it's going to go to the upside. They wait for timing, and then once that timing is right, once the market says to them and reveals certain information to them, they then execute based on what the structure should be doing. And I'm going to show you what that looks like in a minute. Okay. So what do we mean by structure? What is structure? Now, the two types of structure I'm going to show you today, one is an open drive and one is a consolidation breakout. Okay, and what's really fitting is both these examples, the open drive is going to come from the E-mini S&P 500 from Friday the 25th of October, and the consolidation breakout in gold is actually going to come from Thursday the 24th of October, and this is GC. Okay, so we've got two really, really good examples from the past week, and I'm going to show you what both of these structures look like. I'm going to show you what should occur with a structure, and then I'm going to show you what the timing aspect looks like. Okay, and I'm going to show you ultimately why it is that you have to time these types of approaches. Okay, so before we move on to what is order flow price action and why do you need to predict timing, let's go and look at these two structures. Okay. So hopefully a lot of you are familiar with this chart. This is the GC. So this is gold. Okay, this is GC on a daily time frame. And what you're in essence looking at here now, A lot of people will call this maybe a flag. Okay, yes, we are in a nice uptrend, so we could call this a flag with a series of lower highs. Okay. For me, what's important is I'm very fixated and focused on what we call a consolidation breakout. Okay, in other words, the market is just merely consolidating in an uptrend. Okay, so if you've been watching gold all the year, we're up still 15-16% on the year, and we are merely just consolidating our way, a little bit of profit taking, trying to find those buyers. Okay, now over the last 7-8 sessions, the market has begun to coil. Okay, so it's begun to tighten and tighten and tighten, and eventually on Thursday we started to get an up move. Okay, now what's interesting and why these, why I feel this is a really relevant stream for today is that a lot of people would have been calling this long. A lot of people would have been saying, okay, there's a long in gold on offer. Right? And that's the structure. Okay, looking at this, yes, right. Once we took out the top end of that sort of wedge break or consolidation area, in essence, the structure suggested that prices should rise. That's what the structure is telling us. It's telling us that in the event that we do push above that sort of 14.99 area, we should be looking for long-only trades. Okay. The problem with just simply understanding the structure is that imagine you had been buying it on this day, okay? Or imagine you'd been selling it on this day, or imagine you'd been buying it on this day, okay? How many times would you have exposed yourself? How many losses would you have had to rack up before it eventually did what the structure suggested it should do? Okay, and that's the key. That's where the timing aspect comes into. We have to be familiar with potential opportunities as a base case. Okay, we have to know the structure. That's our job, to know the landscapes of our markets. Okay, but what we have to do as professional traders is we have to determine when is the right time for that structure to occur, or for that structural play to be in play. Okay. Now that's the first structure, is the gold consolidation breakout. Now the second structure is the E-mini S&P. Right? A lot of you guys follow, quite a few people that post charts on the ES. Right? Now on my floor this week, I kept saying, it was quite tricky, but I kept saying we have to be long equities this week at some point. Okay, the reason for that was because of the fact of that 29.94. For us, that was quite an important sort of pivot in the market. But again, okay, the timing had to be there. Now watch this very carefully, because this is a brilliant example of being topped and tailed. Okay, once we closed above that 29.94, a lot of people would have been, or what a lot of people would have had, signals going off to be long. Fair enough. Okay, what did it do the very next day? It went down. Then the next day again, we had a really strong close. Okay, full-bodied close at the high of the day, well above the 3,000 mark as well. What do you think the signals would have been sending after that day? Be long. What did the market do? It went down. Okay, the very next day went up again, sent another signal to be long. What did it do the next day? Went down. Eventually it resolved itself, and the equity markets, the cash equity markets at least, made a new record high. So why am I telling you this? What's the purpose of this? Well, again, we can all understand structure. Okay, structurally, the whole week for me, once we were above that 29.94, we had to be long. But the timing wasn't there. The timing aspect of being long was not there until Friday afternoon. Okay, and that's the key, is that anyone can learn structure. Anyone can learn to say, well, you know what, there's a double top, or there's a bad low, or there's a wedge that needs to break, or an uptrend, downtrend. Anyone can learn and identify those structures. Okay, that's the easy part of the game. The hard part of the game is being able to differentiate when your structure is actually in play. Now, before we go to the timing, let's come back to this. So what do I mean by timing? Okay, ultimately timing is nothing other than order flow or price action. Okay, what is price action? What is order flow? All right, it's the market sending you an objective piece of information that price is now going to move in one direction or the other. Okay, so what do I mean by that? If, for example, this was the record high, and you wanted to be long because of the structure. Maybe there was a quadruple day, like in the NASDAQ. Okay, if you go look at the NASDAQ, there was a triple top on the dailies. All right, so we have the structure we want to be long. However, we were waiting for this thing called order flow or price action. Now, let's say, come first thing in the morning, suddenly you see the market doing something like this. Okay, call these 60-minute candles, and we can see we pretty much open at the low, close the high, open at the high, and we continue this sort of process of very aggressive buy-side price response. Okay, that is in essence what we call order flow price action. In other words, it's the manner in which price is moving in one direction or the other. Okay, in this instance, it's very strong order flow / price action. Okay, now I'm going to show you what the timing aspects look like in a minute with the footprint tool. But before we get to that, why do we need to perfect timing? Okay, a lot of you are probably scratching here saying, well, you know, it's okay because my stop didn't get hit and I was long S&P all week and I just had the right stop of whatever, 20 handles, 30 handles, and it's okay. Okay, I made money. Same with the gold. I made money. That's fine. The problem with that synopsis is that taking 30 handle, you know, stop losses or even 10 handle stop losses will never allow you to leverage. Okay, that's the simple fact. And by leverage, I don't mean trading 2 lots or 3 lots. By leverage, I mean being able to trade 200 or 300 lots. Okay, so that's the first aspect. If you want to leverage, you have to learn to perfect your timing. Okay, why? Because if you perfect your timing, what it's going to do is it's going to allow you to have very effective risk management. In other words, if we waited all week in the S&P and we saw something like this, right, we can simply place our stop below where that price response began, right, thus enabling us to say, take maybe a 5-handle loss. Okay, so compare a 5-handle loss to something like a 20-handle loss. Can you see why it is extremely powerful? Okay, it allows us to manage our risk a lot more effectively. Okay, more importantly is the concept of objectivity. In other words, we all talk about structure as though it's you know, like a written rule. Right? For example, the best one I always see, I absolutely love it, is when we got these little flags. Okay, people go, oh, it's a bullish flag. And if I asked anyone, what does a bullish flag do? People go, oh yeah, it's going to resolve itself to the upside, so I just buy it. Now, in textbook theory, there is an element of truth in that, but in reality, it's the biggest load of hogwash ever. Okay, I can show you 100 different examples that actually fail and go the other way. All right, so what perfecting our timing allows us to do, or at least waiting for this order flow and price action, it allows us to be objective. Okay, and what I mean by that is, if a buyer comes in here and our structure suggests that buyers are going to eventually move prices up, right, it's allowing us to be objective. In other words, we're taking the facts from the market and simply just trading off of them. Okay, and the last thing, confirmation. And this is the real key. Right, this is where the confidence comes in your trading, is that if you are structurally confident about something, i.e. I think this market's going to go up, now all of a sudden you perfect your timing and you actually physically see something called buyers stepping into the market, that just confirms that actually our structural approach or our structural understanding is correct. And those four combined, right, those four combined is what ultimately gives you a consistency, gives you a profitability, allows you to obviously become a better professional trader. Okay, now let's go and look at that. Let's go and actually get the gold up and let's have a look.